Hello and welcome to the Business Standard Morning Show. I'm Minu Sandhu. Let's take a look at the stories for the day. India signed a comprehensive free trade agreement with UAE last Friday, over a decade after it inked such a deal with Japan in 2011. This agreement will help shed the perception that India is being too circumspect when it comes to forging such contracts. It will also help in the pursuit to meet India's export target of $1 trillion, both in merchandise and in services, by 2030. So, what does this trade agreement mean for New Delhi, and what is the government planning to achieve through it? This report has the answers.
On February 18th, India and the United Arab Emirates signed the Comprehensive Economic Partnership Agreement or CEPA, which is the first free trade agreement finalized by the Narendra Modi-led government since it came to power in 2014. The deal was negotiated in a record 88 days and will come into force from May. It aims at increasing the non-oil trade between the two countries to $100 billion in 5 years from $45 billion in 2021. The UAE is currently India's third largest trading partner and the second largest export destination after the US, while India is the UAE's second largest trading partner and the largest in terms of exports. The trade pact is expected to benefit around $26 billion worth of Indian products that are subject to 5% import duty by the UAE. The UAE will remove customs tariffs on nearly 80% of the goods, which account for 90% of India's exports to the Gulf nation by value. India expects CEPA to generate 10 lakh jobs across labor-intensive sectors such as textiles, gems and jewelry, leather, footwear, pharma, medical devices, and automobiles. Not just goods, CEPA also covers 11 service sectors and over 100 subsectors, which include business services, telecommunications, construction, tourism, nursing, finance, among many others. The agreement is wide in its scope and includes areas like government procurement, digital trade, and intellectual property rights. To protect the interests of domestic producers, India has kept items such as dairy, fruits, cereals, vegetables, tea, coffee, tobacco, footwear, petroleum, processed marble, among others, out of the trade pact. The trade deal has also provided a permanent safeguard mechanism which will protect exporters and businesses from both countries from any unwarranted surge in volumes of any particular product. The deal comes with stringent rules of origin conditions. At least 40% value addition has been mandated for most goods to avoid routing of products manufactured in third countries to India via the UAE. For the first time in a trade agreement, the CEPA provides for automatic registration and marketing authorization of Indian generic medicines in 90 days, once they are approved in any of the developed countries. India has given duty concessions on gold imported from the UAE, while Indian exporters will get zero duty access to the UAE market for jewelry. This assumes significance as the two countries account for over 16% of the global trade in diamonds, gold, and jewelry. India is looking to enter into a similar agreement with the Gulf Cooperation Council during this year itself. Amityendu Palit spells out the larger importance of the deal beyond the trade aspect and explains how it marks a change in India's approach towards its international trade policy.
I would like to start off by saying that this particular CEPA, to my mind, marks a new beginning in India's external trade engagement. That if we go back over the last 7 to 8 years of India's external trade engagement, then what we see was basically a period of prolonged hesitation because India backed out from a large number of negotiations it was conducting at that point in time, including with Europe, Australia, Canada, and then eventually it walked out of the RCEP. So there was a view that India is becoming increasingly defensive and circumspect of free trade agreements. But this agreement with the UAE is going to change that perception very significantly. India is simultaneously in talks with United Kingdom, Australia, Canada, Israel, the Gulf Cooperation Council, as you mentioned, and European Union. All of these countries are important economic partners for India. UAE has emerged as very significant for India in terms of startups that it has started hosting. The UAE, along with the other countries with whom India is negotiating FTAs right now, are also, broadly speaking, India's very important strategic partners. It's a political relationship, it's a geo-economic relationship. So India is evidently on course to crafting an FTA strategy which doesn't look at these trade agreements just from a trade perspective. The character of trade is increasingly becoming services oriented, digital focused. Now, to that extent, the UAE is probably one of those countries which is offering the kind of ecosystem support and environment which will very nicely fit into a large number of upcoming emerging areas that India envisages, including clean energy and critical minerals trade, and the overall repositioning of various critical supply chains. And the UAE can actually be a hub for that, including pushing India's economic linkages deeper with the African continent, as well as with Europe. So I think it's, to a very large extent, a win-win situation for India.
India had pulled out of the Regional Comprehensive Economic Partnership, the world's biggest free trade deal, signed by 15 Asia-Pacific economies in November 2020, over worries that cheap Chinese imports would flood the Indian market, harming domestic producers. It also faced opposition from farmers, especially the dairy industry. India's manufacturing sector is less competitive in several categories when compared to many other Asian countries. India also wanted stricter rules of origin in RCEP. India's concerns are not misplaced. Analysis by a national daily showed that between FY11 and FY21, exports to 9 countries and 2 trading blocs with which India has trade agreements grew 36% to $62 billion, while imports from these countries grew 44% to nearly $75 billion, doubling the trade deficit to $11.8 billion from $5.8 billion in a decade. India is rushing to finalize mutually beneficial early harvest deals with the countries it is negotiating FTAs with. Such early harvest deals would exclude sensitive issues until a full-fledged FTA is finalized. While SEPA is a good start to help increase the integration of Indian producers with global supply chains, it does not make up for the negative effects of India choosing to sit out of the RCEP.
Like India, a homegrown startup is continuously expanding its footprint across the globe. Software as a service or SaaS startup Icertis, which helps giants like Google, Microsoft, and Apple manage their contracts, has quietly come to dominate the contract lifecycle management market. And it is now aiming even higher, looking at a $50 billion valuation in the next 5 to 7 years. In an interview with Business Standard's Shruti Dasgupta, the company's co-founder Monish Darda speaks about his plans and challenges posed by software bigwigs. Let's listen in.
Software as a service space has obviously been booming, and especially online players. And I mean, there have been various reports also of how this is going to become a game changer for Indian IT services. Obviously, we have the traditional IT services companies, and they are looking at virtually similar markets, which you also look at abroad. So, what are the challenges that you face as a for the industry and for companies like you in this space?
We're probably selling obviously to the same customers, like a Wipro or a Cognizant or an Infosys will sell to Daimler, and we will also sell to Daimler, for example, or Airbus, or any of these manufacturing companies, healthcare companies, pharma companies. But I think our challenges are very different. And the reason I say it is because, we go in a very interesting position now. CLM is a very established category. Gartner, Forrester, all the analysts have given it a magic quadrant and a wave and everything else. So it's a category on its own. And that means that the challenges that we face are actually very different. I think the first difference comes in where the value proposition is already there. The challenge is, hey, will I be able to afford it? How long will it take? And will I fail at it? Which in the case of IT services companies never comes up, right? Usually 3 of the top 5 companies in the world are our customers. So if you look at it from a size perspective, and this is not a small deal, right? They actually roll this out enterprise wide, which means this is multi-million dollar deals. So now the challenges become very different because these challenges are really, hey, can you get me value out of contract intelligence?
How do you get over these challenges from the clients when they say, okay, I mean, it's expensive. Should I have it?
ERP, these are the same questions. Hey, am I going to afford this? Am I going to get value? And how long am I going to take? Exactly the same questions. And we address it in the same way. We say, hey, first of all, you don't have an option. Okay. Second of all, look at the world around you. Look at the Gartner, Forrester, etc. Do you see anyone near Icertis in the enterprise space? And no, there is a lot of white space there. So you don't have a lot of options right now. You will get some options maybe 2 years down the line. I'm sure competition will catch up, and there'll be new companies that come in. But today there is no option. And the third is, the whole idea of cloud native software and built in the cloud is that it can be flexible, it can be fast, and it can be cheaper to implement than most other systems like SAP were traditionally. Now SAP is also moved to HANA, which is the cloud solution, right? And that is why the world obviously has moved to the cloud. And these are the big factors there, apart from the capex.
What is the market size for this? I mean, if you look at globally and I mean, what kind of pole position do you have in this? And is it that none of the bigger players in the IT space are conspicuous by their absence, or are they also looking at this area and they will come in somewhere?
It's very interesting if you reverse back into time, when we started about 8 years ago um, on the contract management journey to the enterprise, we had three competitors. We had IBM. IBM had MTORIS. We had SAP contracts. SAP had an acquisition with CLM, and we had Oracle contracts. Oracle had an acquisition. They had acquired a CLM company. Every RFQ at least had one of these, usually all three, right? And because we had our platform ready and we knew what to do, I don't think we ever lost a deal, any RFP against any of these. All these three competitors vanished pretty much for us. They will come back because the opportunity is so big that it's very hard to ignore. Now they'll come back, and with a large company, you have acquisitions or you have build, and build is going to take too long for them to really fight us, right, or to compete with us. So now acquisition remains the other way of solving this problem, and we are probably too expensive now. So it makes sense to partner, which makes it very interesting because now you can actually have a very interesting conversation where the whole enterprise kind of software and architecture can get a new enterprise object called the contract, which was missing from the enterprise architecture. And it is not just in one segment, it can actually go across the enterprise. That is why our mission is to be the contract intelligence platform of the world, because we think it is possible. We think there is enough, um, kind of opportunity here to say that, hey, contracts can actually bind the enterprise together and the business process together. So people have quoted 2 billion, 3 billion as the market, the CLM spend, which we are already seeing. There's a lot of spend. There's a lot of kind of unstructured spend today in terms of contract management. It was a pleasure talking to you.
Pleasure talking to you too.
But there is a development which is increasingly threatening to derail the world economy. Global stocks slumped yesterday as Europe's eastern flank stood on the cusp of war between Russia and Ukraine. While benchmark indices in India have fallen about 2% so far this year, broader indices have tanked up to 13%, hurting retail investors the most. As markets brace for volatile days ahead amid the geopolitical tensions, here's how retail investors can ride the tide.
The simmering tensions between Russia and Ukraine have kept global equities under pressure for days now. Sliding for the fifth consecutive day, the BSE Sensex dropped 383 points, while the Nifty 50 fell 114 points to settle the day at 58,300 and 17,092 yesterday. Earlier in the day, both these indices have cracked around 1,300 point and 400 points respectively in intraday trade. The developments in Eastern Europe roiled global markets as investors monitored the implications of potential sanctions against Russia and the latter's counter-move, if any. We have Ambarish Baliga with us, who is an independent market analyst, to suggest what possibly lies ahead for the markets.
The global environment is getting risk-off with uncertainty on the Ukraine front. Inflation, tapering, and series of Fed hikes is something the markets are getting prepared for. Closer home, in fact, we have two major events: the run-up to the state elections, results being declared on March 10th. I think the markets will be nervous till then, and then finally will react to the outcome. And more importantly, the LIC IPO, which is scheduled to open in the second week of March, hopefully close by March 14th. I think this will suck out a lot of liquidity. And additionally, we also have advance tax payments on 15th of March. I think that will be a further drain. So expect a decent correction, which will be led by liquidity crunch among the domestic investors, continuous selling by FIIs, and lack of positive news flows.
Back home, investors have lost a chunk of their wealth as the benchmarks have skid around 1.5% so far this year. The broader mid-cap and small-cap indices, meanwhile, have dropped up to 13% during this period. Given this, Dhananjay Sinha, Managing Director and Chief Strategist at JM Financial Institutional Securities, says retail investors should remain cautious and look at quality large caps for now.
For the retail investors, I think they have been fairly exposed to the small cap and mid cap liquid stocks. I think there is a high risk of price erosion. So basically, in the mid cap, we are saying, one has to be cautious. There will be companies that are good and have liquidity in terms of the trading amount, because the risk to price is very high. So I'm we are basically looking at large cap exposure, there is liquid to liquid stock, etc. So basically the approach should be sort of cautious, because we think there is a sort of downside even for the benchmark index. So those are the broad things that sort of everyone is looking at. So be with companies that have long-term growth outlook and which is strong, and be with those companies, and because we think that the market is overvalued, it is expensive. So we need to be, we need to have a good combination of valuation and the companies that we are investing in terms of growth outlook, etc. People who have companies that have low risk to margins and profitability.
Baliga too says retail investors should use any bounce back to get back into cash.
Retail investors, I think, should try to reduce positions, as it will not be a one-way down sort of a market. So utilize bounce backs to get back into cash. I think we should get enough sort of investment opportunities over the next 2 to 3 months at more attractive levels. The sectors which I think are worth looking at for investment at lower levels would be infrastructure, cement, automobiles and ancillaries, FMCG and pharma. The new age stocks could possibly provide you a decent amount of trading opportunities, but for investment, I think I'll stay out for the time being.
That said, from a year-long perspective, Sinha says the year 2022 could be a year of flattish returns with downwards risks weighing more. And he may not be the only one with this view. Multiple headwinds in the form of Russia-Ukraine crisis, Brent crude oil price at $99 a barrel, prospects of faster than expected hike in rates by the global central banks and its impact on bond yields, impending state elections in India, and the fears of a rise in inflation has seen foreign brokerages recalibrate their return expectation from the markets in 2022. Thus, Jefferies has cut its December 2022 target for the Nifty 50 to 17,500, which is around 3.5% higher from current levels. Its 10 mean reversion scenarios put the Nifty 50 December 2022 in the range of 16,500 to 18,500 amid near-term risks, including threat to liquidity due to LIC IPO, continued foreign selling, and a perception that the RBI might be behind the curve amidst the twin deficit concerns. BOFA Securities too has cut its December 2022 Nifty target to 17,000 from 19,100 earlier. Thus, calendar year 2022 may give tepid returns to investors after 2 consecutive years of double-digit gains as outlook for the markets remains indefinite.
After markets, let's move on to legacy issues plaguing the telecom sector. For over a decade now, the government and telecom majors are locked in a battle over payment of one-time spectrum charge. The matter is now in the Supreme Court. But during the last hearing, the government told the court that it was reviewing whether or not to continue with its appeal. This has come as a big relief to the debt-saddled telecom operators. Our next report tells us more about the charge, why it was levied, and its current status.
In 1994, the government gave up its monopoly over the country's airwaves. The move opened the airspace for private players, and the government started making money out of thin air, literally. About 2 decades later, a big chunk of the country's population came to know more about these spectrum allocations through a massive scam. Some even believe that the BJP rode to power while riding high on the anti-Congress sentiments generated due to the alleged scam in allocation of second-generation spectrum licenses. It was alleged that the spectrum sale didn't take place under a transparent auction system and on the basis of market price. The then Minister for Communication and Information Technology, A. Raja, spent 15 months in Tihar jail over it, and in February 2012, the Supreme Court axed the 122 licenses granted to telecom players, declaring airwaves as public goods best utilized through an auction. About 5 years later, a Delhi court acquitted all the accused in the case, citing lack of evidence. But with its image dented due to the allegations, the government had in 2012, after the apex court verdict, decided to levy a one-time spectrum charge on the telecom operators for holding excess spectrum between July 2008 and January 2013. Earlier, the operators used to get additional tranches of spectrum after they reached a certain subscriber base in a circle. After the cancellation of 2G spectrum licenses, the Department of Telecommunications sent notices to telecom operators demanding charges for the spectrum allocated under administrative pricing. The one-time dues stood at around 40,000 crore rupees. It had 2 components. First, a retrospective demand from 1st July 2008 to 31st December 2012 for spectrum held beyond 6.2 MHz. And secondly, a prospective demand from 1st January 2013 to the expiry of spectrum beyond 4.4 MHz. In July 2019, the Telecom Dispute Settlement and Appellate Tribunal set aside the retrospective demand. The government appealed against this order in the Supreme Court, which ordered a status quo regarding the demands. But in October last year, the government indicated that it may withdraw the case. The beneficiaries of such a move would be Bharti Airtel and Vodafone Idea, since Reliance Jio is not a legacy operator. Coming close to the heels of bailing out of Vodafone Idea, this step could be seen as a continuation of telecom reforms. For its part, the telecom sector, which has been passing through financial hardships, will be waiting for a conclusion to this matter with bated breath.
Meanwhile, Nokia has said that 5G network services will be available in parts of the country by the second half of this year if spectrum auctions take place as planned by June or July. That's all for today. For more news and analysis, please log into our website www.business-standard.com. We too will be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.